The three advancing white soldiers pattern is a strong bullish indicator frequently identified in technical analysis. It comprises three consecutive long-bodied candlesticks that close progressively higher, each opening within the body of the previous candle. This pattern suggests a reversal from a bearish to a bullish market. Its significance lies in its ability to signal a robust shift in market sentiment, providing traders with the confidence to consider entering long positions. However, it is crucial to note this pattern's reliability increases when it appears in a downtrend and is supported by high trading volume. I encourage traders to integrate the practice of identifying and interpreting the three advancing white soldiers pattern into their daily trading activities. Becoming adept at spotting this pattern can enhance your trading strategy, giving you an edge in predicting market movements. In conclusion, it is important to remember that the world of trading is dynamic and requires continuous learning and adaptability. While the three advancing white soldiers pattern is a powerful tool in a trader's arsenal, it should not be relied upon in isolation. Combining this pattern with other analysis tools and staying informed about market conditions will greatly contribute to your success as a trader. Candlestick patterns are a fundamental tool in financial market analysis, originating from Japan over hundreds of years ago. These patterns are formed by the price movements of an asset within a specific time frame and are visually represented on a chart. They are widely used by traders and analysts to gauge market sentiment, identify potential reversals, and make predictions about future price movements based on historical price action. Complex candlestick patterns go beyond the basic formations, often involving multiple candles to provide deeper insights into market dynamics. These advanced patterns can indicate continuation or reversal of trends and are considered more reliable by some traders due to the larger amount of data they cover. Examples of complex candlestick patterns include the head and shoulders, bullish and bearish engulfing patterns, and the morning star and evening star patterns. Understanding complex candlestick patterns requires a keen eye for detail and a thorough understanding of market psychology. Each pattern tells a story of the battle between buyers and sellers, with its shape and location on the chart providing clues about the prevailing market sentiment and potential turning points. For instance, the head and shoulders pattern is often interpreted as a sign of trend reversal, where the market transitions from a bullish trend to a bearish one, or vice versa. In essence, complex candlestick patterns offer a lens through which analysts and traders can examine the nuances of market behavior. By interpreting these patterns, market participants can make more informed decisions, anticipate potential market movements, and manage risk more effectively. However, it is important to combine candlestick analysis with other forms of technical and fundamental analysis to construct a comprehensive view of the market's potential direction. Complex candlestick patterns are advanced trading signals that consist of multiple candlesticks, typically more than 3, and are used to predict future market movements based on historical price action. These patterns go beyond the basic single and dual candlestick formations, requiring a deeper understanding of market psychology and a keen eye for detail. Let's dive into a few examples to better understand these complex formations. Firstly, Gartley patterns are a series of highs and lows forming a distinctive shape on the chart, often resembling an M or W. These patterns are significant because they highlight potential reversal points in the market. Imagine a scenario where after a prolonged upward trend, a stock's price action forms a high peak, followed by a slight retracement, another higher peak, and then a final lower trough. This sequence suggests an upcoming reversal from the bullish trend. Secondly, Elliott Wave patterns are based on the theory that market movements follow a series of psychological cycles or waves. This pattern consists of a 5-wave impulse phase followed by a 3-wave corrective phase. Picture a stock price making a strong move upwards in 5 distinct steps or waves, with each peak and trough higher than the last, followed by 3 smaller downward steps. This pattern can signal the end of the trend and the start of a new direction. Lastly, harmonic patterns are based on Fibonacci numbers and ratios to identify potential reversal points. These patterns use precise mathematical ratios to predict how far a market will move in one direction before reversing. Envision a stock that moves up, retraces a bit, makes another move upwards but can't exceed the first high point, then falls below the initial starting point, and finally pushes upwards again but within a specific Fibonacci ratio. While detailed visuals or chart examples cannot be provided here, one can imagine these patterns as intricate and rhythmic dance steps of the market's price movement, each with its own tempo and sequence. The understanding and interpretation of these complex patterns require practice and experience, as they blend mathematical precision with market psychology to forecast market movements. Complex candlestick patterns are an intricate aspect of technical analysis that involve multiple candles, often over several days, providing deeper insights into market sentiment. These patterns have specific characteristics that distinguish them from simpler formations. Identifying complex patterns requires attention to the shape, size, color, and sequence of the candles involved. The shape of each candle within a pattern can vary, including long bodies indicative of strong buying or selling pressure, and smaller bodies or doji candles which signal indecision. Size plays a crucial role, as the relationship in size between consecutive candles can indicate the strength or weakness of the market movement. The color, typically red or green, reflects the market direction, with green for upward movements and red for downward. Finally, the sequence and combination of these candles create the complex pattern, where specific arrangements can suggest continuation or reversal of trends. The pattern's position within a market trend is pivotal for accurate interpretation. A complex pattern that emerges at the end of a prolonged downtrend, such as a bullish engulfing pattern, may suggest a forthcoming reversal to an uptrend. On the contrary, a bearish engulfing pattern at the end of an uptrend could indicate a forthcoming downtrend. Recognizing these patterns in the context of their occurrence within a trend enhances their predictive value. Chart examples are instrumental in showcasing real instances of complex patterns under different market conditions. For instance, a chart highlighting the transition from a bullish to a bearish trend might exhibit a head and shoulders pattern, signaling the end of the bullish phase. Another example is the morning star pattern, a 3-candle formation in a downtrend, which could indicate a reversal to an uptrend. By studying these patterns and their occurrences in various market conditions through chart examples, traders and investors can gain insights into potential future market movements, allowing for informed decision-making in their trading strategies. Complex patterns in financial markets are significant indicators of market sentiment and the psychology of traders. These patterns, which can be intricate and often reflect the collective actions and reactions of market participants, offer insights into the underlying emotional and psychological state of the economy. For instance, a common pattern such as the head and shoulders not only signals potential market reversals, but also illustrates the shifting sentiment among traders. Initially, when the market reaches a peak, the head optimism is at its highest. However, as the pattern develops and the right shoulder forms, indicating a failure to reach a new high, it mirrors a growing pessimism among traders about future market prospects. Similarly, cup and handle patterns suggest a more optimistic shift in market dynamics. The initial drop and subsequent rise, the cup reflect a period of consolidation and rebuilding of investor confidence. The handle's slight downturn followed by an upward breakout represents a final shakeout of doubt, leading to a renewed bullish sentiment. These patterns are not just random shapes on a chart, they are the graphical representation of fear, greed, hope, and resignation playing out in the marketplace. Traders and analysts study these patterns closely because they encapsulate the psychological battle between bears and bulls, offer insights into potential market moves, and help in making informed investment decisions. Moreover, they reflect the intricate shifts in market dynamics, portraying not just the sentiment of individual investors, but also the collective mood swings of the market. A sudden spike in volume accompanying a technical pattern may confirm a stronger market conviction, while divergences between price trends and indicators like moving averages or relative strength index might suggest underlying weaknesses or strengths not visible on the surface. In conclusion, complex patterns in financial markets serve as a lens through which the emotions and psychology driving market movements can be viewed. Understanding these patterns provides valuable insights into future market behaviors and helps in crafting strategies that align with the ever-changing dynamics of the financial markets. Complex patterns in the context of market analysis can act as indicators of either continuation or reversal of a trend. Understanding whether a complex pattern suggests a continuation or a reversal is key to making informed trading decisions. Here, we will explore what typically makes these patterns indicative of one outcome or the other, and provide descriptive scenarios where these patterns have led to various market outcomes, emphasizing the importance of context. Complex patterns such as head and shoulders, double tops and bottoms, and triangles can often be misinterpreted without the proper context. For instance, a head and shoulders formation is generally regarded as a reversal pattern signaling that an uptrend is likely coming to an end. Imagine you observe this pattern forming after a lengthy period of rising prices. Here, the head represents the highest peak, flanked by two slightly lower peaks on either side, the shoulders. When the price falls below the neckline, the support level connecting the lowest points of the two troughs, it suggests a potential shift from a bullish to a bearish market. On the other hand, continuation patterns, such as flags and pennants, typically indicate that the current trend is expected to persist following a brief consolidation. Picture a flag formation during a strong downtrend. You'd see a small rectangle formed by parallel lines that slope against the downtrend, resembling a flag on a pole. This pattern suggests that, despite a brief pause, the selling pressure remains strong and the original downward trend is likely to continue. However, the importance of context cannot be understated. The same pattern could lead to different outcomes under different conditions. For example, A triangle pattern, which can be seen as a wedge of converging trend lines, may require additional confirmation from trading volume or news releases to determine if it signals a continuation or a reversal. In one scenario, the triangle pattern forms during an uptrend with dwindling volumes as the pattern develops. The breakout through the upper trend line on increased volume would confirm a continuation of the uptrend, where investors might see an opportunity to enter or add to their long positions. In another scenario, the same pattern might form under circumstances that suggest market uncertainty, with no significant volume increase on the breakout. Here, the pattern may not provide clear directional guidance, underscoring the need for additional indicators or context to make a confident prediction. Understanding complex patterns requires not just recognition of the pattern itself, but also an appreciation of the market context in which it forms. Analyzing accompanying factors such as volume trends, relevant news, and the underlying market sentiment is essential to interpreting these patterns accurately and making well-informed investment decisions. To validate the implications of complex patterns in trading, several indicators or conditions can be considered. These include trading volume, Fibonacci retracement levels, and the overall market trend. Each of these factors plays a crucial role in reinforcing or weakening the significance of the patterns observed. Trading volume provides insights into the strength behind a price movement. A complex pattern accompanied by high trading volume suggests a strong conviction among traders about the pattern's implications, thereby reinforcing its significance. Conversely, if a pattern forms on low volume, it might indicate a lack of confidence among traders, weakening the pattern's predictive value. Fibonacci retracement levels are another tool traders use to validate complex patterns. These levels, derived from the Fibonacci sequence, help identify potential levels of support and resistance. When a complex pattern aligns with key Fibonacci levels, it adds credibility to the pattern's forecasting ability. For instance, if a pattern predicts a reversal and this reversal starts at a major Fibonacci retracement level, it strengthens the case for the pattern's reliability. The overall market trend is also critical in assessing the significance of complex patterns. Patterns that form in the direction of the dominant market trend are often considered more reliable. Patterns that go against the prevailing trend may still be valid, but are generally seen as riskier and might require further confirmation before acting upon them. In summary, trading volume, Fibonacci retracement levels, and the overall market trend are key factors that can validate the implications of complex patterns. High trading volume, alignment with Fibonacci levels, and conformity with the market trend can reinforce the significance of these patterns, whereas low volume, lack of alignment, and contradiction with the market trend can weaken their implications. Understanding how these factors interact with complex patterns can provide traders with a more nuanced view, aiding in more informed decision-making. The historical accuracy and reliability of complex patterns in predicting market movements have been a topic of considerable interest among investors and analysts. Complex patterns, which emerge from the analysis of financial markets, attempt to capture and predict shifts in market direction based on historical data. These patterns can include a range of indicators from price movements, trading volumes, to other market-driven factors. Historically, these complex patterns have shown varying degrees of accuracy and reliability. In some instances, they have successfully anticipated market trends and reversals, providing valuable insights that have led to profitable investment decisions. For example, certain patterns like head and shoulders or double tops and bottoms are well regarded for their ability to signal significant market shifts. However, it is important to acknowledge the limitations associated with relying solely on these patterns for making investment decisions. The financial market is influenced by a myriad of factors, including economic indicators, geopolitical events, and market sentiment, all of which can significantly impact market movements and at times render these patterns less reliable. Therefore, while complex patterns can offer valuable insights into potential market movements, they should not be used in isolation. It is crucial to corroborate these patterns with other analytical tools such as fundamental analysis, which evaluates a company's financial health, and sentiment analysis, which gauges market sentiment. Using a combination of these tools can provide a more holistic view of the market and help in making more informed investment decisions. In conclusion, complex patterns can be a useful component of an investor's toolkit when used appropriately and in conjunction with other financial analysis methods. Recognizing the inherent limitations and integrating multiple sources of information can enhance the reliability of investment decisions in the dynamically evolving financial markets. Integrating complex patterns with other technical analysis tools such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, or Bollinger Bands can result in a more nuanced approach to market analysis. This integration allows traders to verify signals provided by complex patterns and manage risks more effectively. One method to combine these tools is through confirmation. For example, a trader might identify a head and shoulders pattern, indicating a potential reversal in the market. Before acting on this signal, the trader could look for confirmation from the RSI or MACD. If the RSI shows overbought conditions or the MACD indicates a momentum shift around the same time the pattern completes, this confirmation can provide a stronger case for expecting a market reversal. Another approach is to use Bollinger Bands in conjunction with patterns like triangles or flags. Bollinger Bands can help assess the volatility and potential breakout points. When a price consolidation pattern appears near the edge of a Bollinger Band, it suggests that a breakout might be imminent. Combined with the pattern analysis, this can give a clear entry or exit signal. A real-world example of successful integration involves the use of MACD alongside complex patterns like cup and handle or double bottoms. A trader may observe the formation of a double bottom pattern, suggesting a bullish reversal. By waiting for the MACD to cross above its signal line, the trader gets an additional confirmation of bullish momentum, making it a favorable moment to enter a trade. Engaging in such integrated approaches allows for a comprehensive market analysis, giving traders an edge in predicting market movements more accurately and making informed decisions based on a confluence of signals rather than relying on a single indicator. This strategic amalgamation of diverse analytical tools can significantly enhance the effectiveness of trading strategies. When trading in financial markets, understanding complex candlestick patterns is crucial for accurate market prediction and strategy development. However, traders often encounter common errors and misconceptions that can lead to misinterpretation of these patterns. Identifying and avoiding these mistakes are essential steps toward improving pattern recognition and analytical skills. One common error is the over-reliance on single patterns without considering the broader market context. Traders might spot a complex pattern and assume it indicates a clear market movement, such as a reversal, without taking into account other influencing factors such as volume, market trends, and economic indicators. To avoid this mistake, it is advisable to look at patterns within the context of the overall market conditions. Another misunderstanding is expecting that patterns will always lead to the same outcome. While candlestick patterns can provide insights into potential market movements, they do not guarantee specific results. Markets are influenced by a multitude of factors, and thus, the same pattern can lead to different outcomes under different circumstances. Traders should use patterns as one of several tools in their analytical toolkit, rather than as the sole basis for trading decisions. A further common mistake is the misidentification of patterns due to insufficient experience or knowledge. Many complex candlestick patterns have variations that can be subtle yet significant. Misidentifying these patterns can lead to incorrect analysis and potentially disadvantageous trading decisions. It is important for traders to invest time in education and practice to enhance their pattern recognition skills. To improve recognition and analysis of complex patterns, here are some tips. Continuously educate yourself on candlestick patterns and their variations. There are many resources available that offer in-depth analysis and examples of different patterns. Practice with historical data. Looking back at past market movements and trying to identify patterns and their outcomes can help refine your analytical skills. Use a multi-faceted approach to analysis. Combine candlestick patterns with other analytical tools such as technical indicators and fundamental analysis to gain a more comprehensive view of the market. Maintain a journal of your trades and the patterns you identified. Reviewing your past trades and the accuracy of your pattern recognition can provide valuable insights into areas for improvement. By being aware of common mistakes and actively working to improve pattern recognition and analytical skills, traders can enhance their ability to make informed decisions in the financial markets. In the realm of trading, employing complex patterns to set entry and exit points involves a meticulous analysis of market trends and price movements. These complex patterns are not just random or aesthetic features on a chart. They are the footprints of market psychology, depicting the ongoing tug of war between buyers and sellers. One popular strategy involves the use of head and shoulders patterns, which are revered for their reliability in predicting trend reversals. This pattern is characterized by 3 peaks, with the middle one being the highest, the head, and the 2 others of roughly equal height, the shoulders. A trader might enter a trade when the price falls below the neckline, the support level connecting the low points after the first and second peaks, anticipating a downward price movement. Another strategy uses Fibonacci retracement levels as potential entry and exit points. After a significant price movement, traders can apply Fibonacci ratios to identify possible levels of support and resistance, indicating where the price might temporarily reverse. Entering or exiting trades around these levels can be an effective strategy when combined with other indicators. A remarkable story that highlights the power of complex patterns comes from a seasoned trader who leveraged the cup and handle pattern to capitalize on a bullish market. Observing this pattern, which resembles its namesake with a cup or bowl followed by a smaller handle, the trader identified a consolidation period followed by a breakout. By entering the trade at the breakout point above the handle, they rode the wave of an uptrend, securing substantial profits. These case studies underscore the significance of not just recognizing complex patterns, but also understanding the market dynamics they signify. Combining pattern recognition with other analytical tools and a keen sense of market sentiment can greatly enhance trading decision-making, illustrating the art and science of using complex patterns in trading. When exploring the realm of complex patterns in trading, it is crucial to understand the variations and similarities between them. These patterns, often seen on price charts, offer insights into potential market movements. By analyzing these variations, traders can enhance their strategic approaches to buying and selling. One key example is the head and shoulders pattern, which signals a change in trend. This complex pattern consists of 3 peaks, with the middle one, the head being the highest and the 2 others, the shoulders being of nearly equal height. A variation of this is the inverse head and shoulders pattern, which serves as a bullish signal indicating potential upward movement in the price. The structure is flipped upside down, with the head representing a trough and the shoulders indicating peaks at a lower level. Another significant pattern is the cup and handle, which resembles the shape of a teacup. This pattern indicates a bullish continuation trend, with the cup representing a period of consolidation followed by a breakout, and the handle signaling a slight downward drift before an upward price movement. A variation of this pattern is the inverted cup and handle, indicating bearish potential, where the formation suggests a downward continuation following a price increase and a brief consolidation period. Each of these patterns and their variations can be identified on price charts of different time frames. For instance, in a bullish market environment, a trader might observe an inverse head and shoulders pattern forming over weeks or months, suggesting a long-term investment opportunity. Meanwhile, in a shorter time frame, such as daily charts, a cup and handle formation might suggest a shorter-term trading strategy. Interpreting these patterns within their specific market contexts is vital. Factors such as volume, the overall market trend, and external economic indicators can influence the reliability and implications of these patterns. For example, a head and shoulders pattern spotted during a market downturn, accompanied by declining volume, might signal a strong sell opportunity. Conversely, an inverse head and shoulders pattern during market recovery phases with increasing trading volume can indicate a robust buy signal. In summary, understanding the nuances of complex patterns and their variations in trading charts can offer traders valuable insights into market dynamics, aiding in making informed investment decisions. These patterns, when interpreted accurately and within the broader market context, can serve as powerful tools for forecasting future market movements.